All right. So, you guys have been sending in some really fascinating articles and stuff about all the recent stock market activity. We're gonna deep dive on this today and specifically look at this pretty significant 2-day drop that we just saw in the S&P 500.
Yeah.
And I think our mission here is to try and kind of cut through the immediate headlines and try and give you a little bit of historical context. Use these articles from the Motley Fool and some of these other sources to help you understand what could happen next and try to not overwhelm you with charts and a bunch of jargon.
I think, everybody is seeing this stuff in the news and the fluctuations, and, it's natural to want to understand what's going on.
Yeah.
So hopefully we can provide a deeper perspective grounded in history.
Oh, okay. So let's maybe rewind a little bit. It wasn't that long ago that the market felt like it was on this relentless upward march.
Yeah.
Right. We had all the energy around artificial intelligence. The U.S. economy was showing some surprising strength. And even some of the big stock splits were generating excitement. It really did feel like a wave of optimism that kind of pushed all those major indexes, the Dow, the S&P 500, and the Nasdaq, up to some pretty impressive peaks, right?
Absolutely. It felt like, all cylinders were firing, lots of different parts of the market participating, a lot of different reasons for folks to feel, bullish.
Yeah. Totally. But the picture's definitely changed a bit in the last 7 weeks or so.
Mm-hmm.
Since around, February 19th. We've seen this kind of noticeable shift. And by April 7th, the Dow had come down by nearly 15%, the S&P 500 had dropped by over 17%, and the Nasdaq, had seen a pretty substantial decline of more than 22%. Yeah, I mean, those are the kind of numbers that definitely make you kind of sit up and pay attention, right?
Yeah, those are big moves, and for anybody watching their investments, their portfolio, those kinds of drops can understandably feel concerning.
Absolutely, and then came these 2 days that really kind of grabbed the headlines, April 3rd and 4th, and the S&P 500, it took a really sharp dive, lost a considerable 10.5%, 10.5% in just those 2 trading sessions. And here's where it gets really interesting, right? Our sources are indicating that this was actually the 5th largest 2-day percentage decline for the S&P 500, going all the way back to 1950. So that kind of puts it in pretty exclusive company, and frankly, a little unsettling, right?
Yeah, I mean, what's fascinating is, you think about a 10.5% drop in 2 days. That's a rare occurrence, and so you immediately start thinking about, well, what could cause that, right? What could trigger such a sudden and significant shift in market sentiment?
Yeah. Well, one of the primary factors that our sources are pointing to is this uncertainty that followed President Trump's announcement of his Liberation Day tariff policy on April 2nd.
Okay, and this policy, this is potentially very, very broad, as I understand it. It proposes like a flat 10% tariff on goods that are coming into the U.S. From all countries, in addition to what are being called reciprocal tariffs that target nations where the U.S. has a persistent trade deficit with.
Yeah, exactly. And the thinking behind this, at least according to Trump, is that these tariffs, they're going to generate revenue for the U.S. government. They'll help to bring back American jobs. They'll encourage more domestic manufacturing and give the U.S. more leverage when it comes to renegotiating existing trade agreements that he believes aren't really favorable to the country.
Okay, so those are the stated goals, and I can see how they might resonate with some.
Right.
However, as the articles that you've shared are highlighting, the economics of tariffs can be pretty intricate, and there's a really important distinction to understand between tariffs on finished products that are those are often called output tariffs, and tariffs on goods that American companies use in their own production process, and those are your input tariffs.
Yeah, and that's where the potential complications kind of come in, right? Mm-hmm. Because tariffs on inputs, like if a U.S. manufacturer imports steel or semiconductors or whatever it is, that could actually lead to higher inflation. Because if a company's costs go up because of these tariffs, well, they might have to pass those costs on to consumers through higher prices, right? And that would be especially worrying if the economy isn't growing very, very quickly.
Right.
So it's a little bit of a tightrope walk.
Yeah, yeah. So for example, if we think about a US car manufacturer and they are importing steel that's an input,
Right.
a tariff on that steel could increase the cost of producing cars domestically.
Right.
So imposing tariffs, especially on those intermediate goods, can really disrupt established supply chains.
Yeah.
And then potentially lead to increased costs for both American consumers and businesses. And so that could potentially offset, some of the intended positive effects of the policy.
Yeah, absolutely. But the tariff situation isn't the only piece of this puzzle that our sources are highlighting. There's also this factor of where stock market valuations were sitting just before this decline.
Right. Yeah, I think we need to take that bigger picture view of the market environment as well. And so the S&P 500's Shiller Cape ratio, which is a way of looking at the price to earnings ratio.
Yeah.
But adjusted for inflation over the past 10 years, was at a really elevated level as we enter 2025. And so think about the regular PE ratio, which compares a company's stock price to its earnings per share. Well, the Shiller PE takes that a step further by looking at average inflation adjusted earnings over the last 10 years.
Right.
And so it kind of smooths out short-term earnings fluctuations, and it gives us a longer term view of how expensive the market is.
Yeah.
And by this measure, the market was looking pretty pricey.
Yeah.
In fact, it was the third highest premium that we've seen during a bull market in the last 154 years.
Wow. Okay, so let's put some concrete numbers on that. So the Shiller PE ratio hit a peak in December 2024 at nearly 39.
Wow.
And if you compare that to the historical average since way back in 1871, which is around 17, you see this pretty significant gap.
Yeah.
And it suggests that investors were on average paying a much higher price for stocks relative to their earnings compared to historical norms.
And what's fascinating is if you look back at market history, there have only been 5 other instances in those 154 years where the Shiller PE ratio has stayed above 30 for more than 2 months.
Really?
And in each of those prior occurrences, the major stock market index has subsequently experienced substantial losses, ranging from a 20% decline all the way to an 89% drop.
Wow. Okay. That historical context really makes those high valuation numbers feel a lot more significant, doesn't it?
Mm-hmm.
It suggests that while investors might be willing to pay a premium for stocks for a while, there seems to be a limit to that.
Right.
When the market stays significantly above its long-term valuation averages for an extended period, it's often followed by some kind of correction.
Right. Yeah, it implies that investors, become more sensitive to negative news or uncertainty when valuations are already, stretched. And so the announcement of the tariff policy likely acted as that trigger, causing investors to reevaluate those high valuations and prompting, a sell-off.
Okay, so we've covered the backdrop.
Yeah.
The strong run-up, the recent pullback, and then that sharp 2-day drop.
Yeah.
Potentially sparked by these tariff worries and then amplified by those historically high valuations.
Mm-hmm.
So the big question I think that's probably top of mind for a lot of you guys is what does history suggest might happen next?
Yeah, and this is where the research from Charlie Bolello, the chief market strategist at Creative Planning, becomes really, really insightful.
Okay.
He looked at the 10 largest 2-day percentage drops in the S&P 500 since 1950. And these declines ranged from a 9% drop all the way down to a 24.6% decline.
Wow.
And as we noted earlier, our recent 10.5% drop falls right in the middle of that range as the fifth largest.
Yeah.
And the really, really striking takeaway from Bolello's analysis is the consistency of what happened after these big 2-day drops.
Okay.
According to to his data, in every single instance where the S&P 500 fell by at least 9% in 2 days, it showed significant gains in the following 1, 3, and 5 years.
Wow.
And this is looking at, the total return, which includes dividends, so it really gives a full picture of investor returns.
Yeah.
So that's absolutely right. And the data is pretty compelling. On average, 1 year following these major 2-day declines, the S&P 500 was up 31.8%. On a total return basis.
Wow.
Looking at 3 years, the average total return was 50.2%. And if you held on for 5 years after those big drops, the average total return jumped to 121.9%.
Wow. Okay, those are some pretty impressive numbers.
Yeah.
And to really appreciate that, one of our sources reminds us that the average annual return for the S&P 500 from 1957 through March 2023 was roughly 10.5%. So what this historical data suggests is that these periods of sharp, rapid decline have actually been followed by periods where the returns have been significantly above the long-term average. There seems to be a real potential for outsized returns after these kind of events.
Yeah, it really highlights the idea that while these sudden market drops can feel really alarming in the short term, historically they've often presented opportunities for significant long-term gains.
Yeah.
And it kind of suggests that trying to avoid those dips by selling out of the market might actually mean that you miss out on the subsequent rebound.
Yeah, absolutely. And our sources extend this long-term view even further by including data from Crestmont Research. And they've examined the rolling 20-year total returns of the S&P 500 all the way back to the year 1900.
Wow.
I mean, that's an incredibly long period.
Yeah.
Encompassing all sorts of economic booms and busts, wars, and other major global events. And just to be clear, when we talk about rolling 20-year total returns, imagine looking at every single 20-year period since 1900. So 1900 to 1919, 1901 to 1920, and so on.
Okay.
We're looking at the total gains you would have made if you'd invested for each of those 2-decade stretches.
Okay. Yeah.
So Crestmont looked at a total of 106 different 20-year periods.
Wow.
With the last one ending in 2024, and their finding is remarkably consistent. Every single one of those 20-year periods produced a positive annualized return for the S&P 500.
Really?
Every single one.
That's incredible.
Yeah, it means that even if you had invested in the S&P 500 at pretty much any point in the last 124 years and held on for 2 decades, you would have ended up with a positive return on your investment.
Yeah.
And this holds true despite all those major crises that occurred during those times.
Right.
The Great Depression, multiple recessions, world wars, pandemics, various stock market crashes. I mean, the list goes on.
Yeah.
So even if you had the absolute worst timing, within those 2 decades, you still came out ahead. I mean, that's kind of amazing to think about.
Yeah, it really underscores the resilience of the market over the long term, and the importance of having a long-term perspective when it comes to investing. Despite the inevitable ups and downs, the overall trend has been upward.
Yeah. Absolutely. So to kind of bring it all together for you guys, the listeners, while that recent 2-day drop in the market might have felt really significant, and the factors contributing to it, the uncertainty around tariffs, the high stock valuations, those are certainly important to understand. The historical data that follows similar sharp declines offers a really reassuring perspective for those with a longer term investment horizon.
Right. History doesn't repeat itself perfectly, of course, but it often provides valuable insights.
Yeah.
And the evidence that we've looked at today suggests that these kinds of market jolts, while unsettling in the short run, have historically been followed by periods of significant recovery and growth.
Yeah, absolutely. This really brings home that aha moment, doesn't it? Seeing that consistent pattern of recovery after sharp drops, playing out across so many decades of market history, it definitely kind of encourages us to take a step back and and look at the bigger picture.
Yeah. It reminds us that short-term market noise can be very distracting.
Yeah.
And focusing on the long-term trends and the historical tendencies can be a much more helpful approach for navigating, the world of investing.
Yeah, absolutely. So here's a final thought for you guys to kind of consider. How might this historical perspective on market downturns influence your own long-term financial strategy?
Yeah.
When you see those future market fluctuations, how will you balance those immediate feelings of concern with the historical tendency of the market to not only bounce back but to continue growing over time? It's definitely something worth thinking about as you continue on your investment journey.
Yeah, for sure. I think it's a good takeaway to try to ground yourself in the bigger picture.
Yeah.
Take a breath. These things happen.
Yeah.
But historically, we've always come out the other side.
Yeah. Okay. Well, thanks for helping me break down all this information.
Absolutely. Glad to be here.
It's always a pleasure talking to you and getting your insights.
Yeah.
All right. We'll talk to you guys next week.
Sounds good.
All right. See ya.